Welcome to this explainer. Okay, if you're a BS accountancy student gearing up for the LECPA in the Philippines, you are in the exact right place. Today, we're literally going to hack your brain to master corporate tax. Specifically, we are tackling a topic that trips up countless examinees, the minimum corporate income tax, or MCIT. So, let's test your focus right out of the gate. The rules we're covering today, they need to stick in your mental hard drive, not just for your next quiz, but for the next 2 or 3 years until you actually sit down for that board exam. Your brain is totally wired to forget dry facts, but it remembers patterns, stories, and contrast, and we're going to use that to our advantage. To pull this off, we're completely skipping the traditional, boring textbook reading style. Instead, we're leaning into cognitive microchunking and pattern recognition. We'll break the complex Philippine tax code down into bite-sized, visual pieces to encode this stuff deeply into your long-term memory. All right, here's our agenda, basically your survival roadmap. Number 1, hacking the MCIT basics. Number 2, the fourth-year rule. Number 3, the MCIT versus RCIT showdown. Number 4, the 3-year carry forward. Number 5, compliance guide. And finally, number 6, a bullet review and hacks. Let's dive right in. Section 1, hacking the MCIT basics. You really need to understand why the Bureau of Internal Revenue even enforces this. Think of the MCIT as the government's ultimate safety net. It exists because, well, some corporations have massive turnovers but somehow report zero net income. So the MCIT ensures that domestic and resident foreign corporations actually contribute their fair share, regardless of those massive deductions. Lock this number into your brain right now. 2. The standard MCIT imposition rate is exactly 2% of a corporation's gross income. And this is a massive detail they love to test. You've got to remember that due to the CREATE law transition, the rate was blended to 1.5% specifically for the calendar year 2023. Even so, your foundational rule to always anchor back to is 2% of gross income. Moving on to Section 2, the fourth-year rule. Now, the BIR is actually kind of reasonable here. They don't hit a startup with MCIT on day 1. They give them some breathing room to recoup those initial major capital expenditures. The magic number for this grace period? 4. Associate MCIT with the number 4, and honestly, you're already ahead of the curve. Let's mentally map out this timeline. The rule specifically states that the MCIT applies starting on the 4th taxable year immediately following the year business operations commence. So, you start in year 1, you enjoy a nice grace period for years 2 and 3, but the second year 4 hits, that MCIT rule is officially activated. But wait, are there exceptions? You bet. Keep in mind, if the business suffers severe, unusual losses, this rule can legally be suspended by the Secretary of Finance. There are 3 triggers you need to memorize: a prolonged labor dispute, force majeure, think massive natural disasters, or legitimate business reverses. If you see those exact terms in a problem, the MCIT might just be paused. Section 3, the MCIT versus RCIT showdown. Like we said, our brains remember contrast best, so let's pit them against each other. The fundamental difference here is the base. The regular corporate income tax, or RCIT, applies 25% or 20% to net taxable income. That's after allowable deductions. But the MCIT, that's 2% applied to gross income, meaning sales less cost of goods sold before operating expenses even enter the chat. And here is the golden rule. This is absolutely crucial, the core of Philippine corporate taxation. The corporation must pay whichever is higher between the computed RCIT and the computed MCIT. Examiners will totally try to trick you by giving you both sets of data. Your job, compute both, compare them, and the higher number wins, every single time. And this showdown isn't just a once-a-year thing. It happens every single quarter, and then again on a cumulative annual basis. Look at it this way. In Q1, RCIT is higher, so that's your tax due. In Q2, suddenly MCIT is higher, so it takes the lead. Then come the annual income tax return at year-end. You compare the cumulative totals all over again. Whichever total is higher is your final tax due for the year. Section 4, the 3-year carry-forward rule. Okay, so what happens if you essentially overpay because you were forced to use that higher MCIT? Does the government just keep your extra cash? Not quite. It becomes what's called excess MCIT, literally the exact amount by which your MCIT exceeded your RCIT. That difference transforms into an income tax credit you can use in the future. Spatially map this out in your head. You can carry this excess forward and credit it against your tax for the 3 immediately succeeding taxable years. But if you don't use it by the end of that 3rd year, it completely expires. So any excess generated in year 1 can be used in years 2, 3, and 4. After year 4, poof, it is gone forever. Let's use some active recall to make sure this is actually sticking. Ask yourself this right now. If your current tax due for this year is the MCIT, can you deduct your prior excess MCIT from it? Give it a guess. The answer is a massive hard no. And listen, this is exactly where students hemorrhage points on the LECPA. Excess MCIT can only be deducted if your current tax due is based on the regular corporate income tax. If you're stuck paying MCIT again this year, you cannot touch that prior excess MCIT. You just let it sit there and carry it over to the next year. You can, however, still deduct things like creditable withholding taxes and prior quarter payments, just not the excess MCIT. Section 5, Corporate Tax Compliance Guide. Nailing the computations is great, but you absolutely need the compliance mechanics for the exam. For your quarterly declarations, you'll use BIR Form 1702Q, and that's due 60 days following the close of the quarter. But for your massive annual reckoning, you use the 1702 series, and that deadline is the 15th day of the 4th month following the close of the taxable year. Memorize those, they are easy points. Section 6, Bullet Review and Study Hacks. All right, we are triggering the spacing effect right now to cement these neural pathways. If you want to screenshot this, this is the one to grab. These are your core hacks for navigating those paragraph-long LECPA problems. Remember, MCIT is 2% of gross income. It kicks in on the 4th year. Always pay the higher of RCIT or MCIT. Your excess MCIT lives for exactly 3 years. And crucially, it can only be credited against an RCIT liability. So I'll leave you with this final thought. In a couple of years, when the board exam presents you with a massive table of quarterly incomes, tricky carry-forward rules, and varying tax rates, are you going to panic? Or are you going to remember the showdown? You've got the mental architecture now to analyze literally any corporate tax scenario they throw at you. Keep drilling these patterns, keep using active recall, and make this second nature. Thanks for joining this explainer, and happy studying.